In my videos, I always talk about why I love dividend investing. You know, a lot of investors fail to see the power of dividends. What they do is simply withdraw the money since they feel those small returns wouldn't do much. Although it's true in the short term, you wouldn't feel much the effects of it. 1 to 3% returns are small, but step back a little and look at it at a much wider time frame. Those small returns over the long run will create a radical difference in your portfolio's return. In fact, a study done in the S&P 500 shows how powerful reinvesting dividends is. It shows the percentage of dividends in the total returns of the index each decade. Some decades shows us dividends take up the majority of the returns, such as the 1940s where 67% came from dividends, 1960s 40%, and in the 1970s a whopping 73%. If we take the average of all of this from 1930 up to the end of 2021, dividends take up 40% of the overall return of the US index, and it does not stop there. Another data shows from 1960 to 2021, if you didn't reinvest dividends and rely solely on pure capital gains, the $10,000 you invested in 1960 would only grow to $795,823. Still not bad. You multiplied your money a lot. But the difference if you reinvest all dividends is huge. With dividends, your $10,000 would now be worth $4.9 million, just a little short of reaching $5 million. Just imagine, those small returns some investors take for granted create this much difference in returns. So to say dividends don't matter and are not worth the time is such an understatement. Now I can go on and on. They say dividend investing isn't worth it since it does not even catch up to the returns of the main index. But that isn't for every country. In the Philippines, we have a new index which is the PSE Dividend Yield Index, or PSE Divi for short, which invests in dividend-paying companies. The index is well diversified in different sectors, having a dividend yield of 3.80% compared to the main index, the PSEI, of 1.54. Now take note of the price-to-earnings ratio of the dividend index, it's only 15.70. As for the main index, its total PE is 23.80, which means most of its components are relatively priced higher and some are even overvalued. Now they tracked the two indices starting in 2010 and the results were shocking. The PSE Dividend Index had a higher return than the main index. Although there are some years that the dividend index underperformed, but it's only by a small margin. This actually shows dividend investing in the Philippines is superior, and this is with its components having a lower price-to-earnings ratio. Now we can't say if this will go on for the years to come, but seeing as our main index sometimes stagnates, this had happened in 1997 to 2010, and again in 2014 up to the present day. This is important to know because although prices don't move, but while doing so, companies sometimes still pay the same amount of dividends, and some even increase it. So just imagine if the prices of stocks do not move for more than 10 years, you are still getting paid while waiting. And those dividends, if reinvested, will earn more dividends for you the next year. And this will cope for the lack of movement in the market. This is the case for the two indices. While prices are going down, the companies in the PSE Dividend Index are still paying dividends consistently. So this proves and crushes those saying that dividends are a waste of time and are not worth the effort. Because two indices, both the S&P 500 and the PSE Dividend Index, show how important dividend is in the long-term gains of our portfolio. Anyway, dividends is important because one, and I think is the best advantage of it, is it provides a better cash flow for you. Unlike relying on capital gains, in dividend investing, you still get money without doing anything. Just by holding that stock alone, you get money consistently every year. This is also the main reason why I love this strategy. It is much more predictable. No matter how good you are at analyzing companies, charts, etc., no one can predict the movement of prices. Unlike for dividends, if that company consistently earns and grows, you know you'll get paid. This is the case during the pandemic. When all companies' stock prices crash, they still paid dividends, but I know they would decrease their payout because companies are reporting lower earnings. So for dividends, it is easier to predict. And another advantage that is related to having better cash flow is you get to cost average easily. It is known that no one can predict the market, and that being in the market and buying at different time frames is the best way to go. But some of us lack the capital to do so. With dividends getting reinvested, This solves that problem for you. You get that helping hand to consistently invest no matter what market cycle we are in. Another advantage this brings up is passivity. With you automatically reinvesting dividends, your investing style becomes somewhat passive, which is a big advantage. Passive investing is known to be superior to actively trading stocks. This is seen in the returns of the index. 80% of the time, indices which are just passively investing in their components have outperformed actively managed funds, which try so much to time the market. Imagine, just by consistently cost averaging, passively investing month after month in the same stocks and its components, index funds beat those so-called experts that analyze charts and are actively trying to time the market. Do you know why this happens? Because by being passive, you take out one important factor that causes a lot of investors to fail in investing, and that is emotion. Emotion is the driving factor of stocks going down and up. When there's bad news, investors tend to sell their stocks, some even at a loss. And when the economy is doing better, investors flock the market because they feel they will be left behind if they don't invest now. Do you see what's happening? By being emotional, you don't stand by the known rule of buying low and selling high, buying great companies at a discount. When you let emotions take control, most investors tend to do it the other way around. Buy high due to the fear of missing out when there's a hot trending stock, and selling low due to the fear of losing all their money because of all the negative news in social media. Now, dividend investing actually helps with this. If you really can't control your emotions, then just know that you need to reinvest your dividends automatically. Have a dividend reinvesting plan, so whenever you get dividends, you automatically put it back no matter what market cycle we are in. This lets you cost average during times of uncertainty when all investors are afraid to buy. This is the chain reaction that dividends make. By being passive, this helps you control your emotions, and having a consistent cash flow going into your account also helps in controlling it, because when stocks are down, you are still earning in the process and can just wait for the market to settle down. And by having your emotions in check, you get to stay in it in the long run, which is the best way to go when investing. You get to tap into the power of compounding interest both from capital gains and dividends. It is already proven that long-term investing is the best strategy for most investors. Just look at the returns of the index. Yes, there are times it goes down and sometimes doesn't even move, but look at it in a much wider time frame. In the long run, not less than 15 years, stocks have provided a good amount of returns, so dividends help a lot in your survival. Now, there are different ways you can approach dividend investing. You can be a pure dividend investor by just looking at dividend yield alone, but I don't like this style since dividend yield can sometimes be a trap. Some companies may not have good financials that can sustain its payout. Another strategy is you can just copy what the dividend index is investing in. You can just passively invest in those stocks. Or better, find the dividend index and consistently invest in that fund. This is the easiest way to approach it. Find high dividend indices, then invest in those funds. Sadly for the Philippines, I don't know if there are funds here which pay you dividends yearly. The third strategy is what I use, dividend value investing. I look for great companies that have good dividend yield and pay consistently and are also undervalued. My meaning for great companies, their financials are solid, debts are manageable, and it has the potential to grow more in the future. With this, I know that company would last long and they can maintain easily what they are paying me, and even has the potential to increase their payout. With the company growing, usually their dividends grow along with it. This for me is the best way to approach dividend investing if you're going to invest in individual stocks. And by the way, one platform that can help you analyze stocks and keep track of your portfolio is simply Wall Street. This platform has helped me a lot. You can easily get an update of what is happening in the stocks you own, from dividend announcements, insider trading, earnings release, and a lot more. And if you don't know how to compute a buy price for a certain company, then they also have their own computation. This can guide you a lot, and there are a lot more functions for you to level up your investing journey. So if you want to sign up to Simply Wall Street, by using my link below, you get a 14-day free trial of all their platform's features, and if you do avail of their plan by using my link, you get a 30% discount. So grab this opportunity to level up your investing journey. Anyway, back to the video. So if you do have the time to analyze companies, then go for this strategy, but don't force it. If you know you don't have the time and skills to analyze stocks, and you know you're prone to panicking when the stock price of the companies you hold goes down, then just find an index fund that pays a good amount of dividends per year. It's far easier. So in conclusion, do not underestimate dividends. It has been proven time and time again that it is an important part of growing your portfolio. Use it to compound your money, and there may come a time when the dividends you get every year will be bigger than your main source of income. That's actually my goal, to retire from the dividends I get. How sweet is that? Retiring early and being paid without doing anything. With that, this ends this video for today. I hope you've learned something, and if you did, be sure to click the like button before you leave. And if you haven't signed up to Simply Wall Street, do it now. There's nothing to lose. Grab your 14-day free trial or that 30% discount if you avail of their plan. Thank you, and see you in the next video.